Welcome, everyone. You're joining us today, August 24th, Sunday. It's 10 p.m. Eastern Time, 7 p.m. out on the West Coast.
And welcome to ZZ Financial.
Hmm.
We are committed to providing the most accurate, valuable, and timely information and analysis.
And it's certainly been, well, quite a whirlwind in the financial world this past week, wouldn't you say?
Absolutely. A whirlwind is a good way to put it.
We've seen some really significant shifts in market sentiment, pivotal policy announcements sending ripples everywhere, and some truly intriguing company-specific news, too, especially coming out of Japan. As we start to dig into this week's headlines, what's caught your eye the most? Where should we begin to, unravel these stories?
Well, it's been an extraordinary week, truly. The events, especially the last few days, they really serve as a powerful reminder of just how interconnected our global financial markets are and how quickly sentiment can really pivot. We've definitely seen major ripple effects from central bank actions, especially, yes, here in the U.S. from the Fed, but also that ongoing tech rivalry playing out on a global stage, that's been fascinating. And then some really surprising domestic economic indicators, particularly from Japan, that give us a unique kind of pulse check on that fascinating economy.
Okay.
So our mission today is really to take all these threads, these different pieces, and try to weave them together, unravel these complex, interconnected stories for you, our listener. We want to provide the essential context and, importantly, the crucial implications you'll need to stay well-informed. There's certainly a lot to discuss, so let's get right into it.
The Jackson Hole Aftershock, Powell's dovish pivot, and global reactions.
Okay, let's unpack this. What really dominated the headlines, grabbed everyone's attention, particularly here in the U.S., was Federal Reserve Chair Powell's speech, right?
Oh.
At the Jackson Hole Economic Symposium.
That's right.
This isn't just any conference, is it? It's always seen as this, well, high-stakes event, almost like a ceremonial platform for central bank communication, a moment when the world really hangs on every single word.
Exactly right. Jackson Hole is, without a doubt, one of the most closely watched events on the global central banking calendar. It serves as a critical platform. Central bankers from all over the world come not just to discuss key economic challenges, but crucially, to subtly or sometimes not so subtly signal their policy intentions.
Right, send those signals.
And communicate shifts in their economic outlook. This year, Fed Chair Powell's speech on August 22nd was, well, it was definitely the single most significant market driver. His carefully chosen words, they truly set a new tone, sent shockwaves, really, through global markets.
So what exactly did he say? What caused such a stir? What were those specific phrases, maybe those coded messages that got everyone talking and immediately reevaluating everything?
Powell's core message, it really revolved around emphasizing the evolving risks to the economy. There's a notable shift in focus. He specifically mentioned downside risks in employment, highlighting concerns about potential weakening in the labor market. That was key.
Okay, downside risks in employment.
And perhaps even more importantly, he stated quite clearly that changes in baseline economic outlooks and risk balances could justify adjustments in policy stance. Now, like you said, these aren't flashy sound bites for, the general public, but in the nuanced language of central banking, they're incredibly potent signals. They're like subtle movements in a very carefully choreographed dance, right? Each step carries significant meaning.
I understand. And how did the market, which is always trying to read between the lines, how did it interpret that? Because it really felt like everyone suddenly just breathed this collective sigh of relief, like a heavy weight had been lifted.
The market's interpretation was swift and decisive. It widely interpreted these carefully chosen words as Powell opening the door to a September rate cut.
Ah, okay. That's the key phrase.
Exactly. This represented a pretty significant, almost dramatic shift from the more cautious, maybe even slightly hawkish sentiment that had been building just days before. The relief you observed, it was palpable because it signaled a potential pivot from the Fed's previously quite firm stance. It offered a glimmer of hope for lower borrowing costs, maybe sooner than many had started to expect.
Now, you mentioned the relief was palpable. What exactly made this speech so dovish? I thought the Fed was still really worried about inflation, still sounded pretty hawkish just recently. Was it just a change of heart, or is there something deeper in the economic landscape that maybe prompted this shift?
That's a pivotal question, and it really gets to the heart of understanding market psychology and central bank communication. The context right before Powell's speech is absolutely crucial here. In the days leading up to Jackson Hole, we had heard remarks from other influential Fed officials. For instance, Kansas City Fed President Schmid, Cleveland Fed President Hammack.
What did I remember those comments?
They had both publicly expressed considerable reluctance toward early rate cuts. Their statements emphasized that inflation, okay, it's moderating, but it's still above target. And the labor market, despite some cooling, remained remarkably robust. So these cautious comments had effectively dampened market hopes. They caused the probability of a September FOMC, that's the Federal Open Market Committee rate cut, as tracked by the FedWatch tool, to fall. It went from nearly 100% just a week earlier down to below 80%.
Okay. So the market had already started to kind of lower its expectations, was bracing for maybe a longer period of higher rates.
Precisely. So when Powell stepped up and counteracted that cautious sentiment by explicitly mentioning downside risks in employment and the potential for adjustments in policy stance, it was a clear and powerful signal. He wasn't ruling out an early cut. In fact, he was actively acknowledging the possibility of it, which was a marked contrast to his colleagues' more hawkish tone just days before. Think of it like a captain steering a large ship. Previously, the captain was very cautious about increasing speed because of potential storms on the horizon, right?
Right.
But suddenly, new weather forecasts come in. They suggest not just storms, but maybe unexpected icebergs or strong countercurrents that could actually slow the ship down more than anticipated.
Okay, new risks.
Exactly, new and different risks. So the captain hints at a slight change, of course, not just to avoid the storms, but to navigate these new risks more effectively. Everyone on board who had been bracing for a rougher, slower ride suddenly feels a lot more optimistic about reaching their destination smoothly, maybe even a bit sooner.
Okay.
That's essentially what Powell achieved with those words.
I see. That analogy makes it incredibly clear.
Right.
And the market's reaction, wow, it was immediate and incredibly strong. Across the board, it seemed. Can you walk us through the specifics, that euphoria across different markets?
Absolutely. The market's reaction on August 22nd was indeed strong, broad, and frankly, quite euphoric, directly reflecting these renewed rate cut expectations. And this renewed optimism, it didn't just lift stocks, it sent ripples across the entire financial landscape.
Let's start with stocks then.
Okay, take the U.S. stock market. The Dow Jones Industrial Average surged an impressive $846.24. That's 1.88%. This wasn't just a rebound, it signaled a powerful, almost reflexive surge of market optimism. Investors eagerly priced in the perception of a dovish Fed pivot, temporarily overshadowing maybe some underlying economic concerns.
Right.
It marked its highest level in 8.5 months, and it achieved its largest single-day gains since May 12th. The NASDAQ composite, heavily weighted with tech giants.
Yeah.
And the broader S&P 500 also saw significant rebounds, gaining 1.87% and 1.51% respectively.
That's a huge jump for just one day. What was really driving all that excitement? Was it just the rate cut hopes?
Primarily, yes. Investor optimism for interest rate cuts. Lower rates are generally perceived as highly supportive of the U.S. economy. They reduce borrowing costs for businesses, for consumers, and crucially, they help alleviate concerns about the relative overvaluation of stocks. They make future earnings appear more valuable in today's terms.
Okay.
We saw notable gains across various sectors, particularly economically sensitive ones like industrial bellwether Caterpillar, financial giant Goldman Sachs, alongside consumer-related stocks such as Home Depot. This broad-based relief was so significant that the CBOE Volatility Index, the VIX...
The fear index, right?
Exactly, the fear index. It actually fell to its lowest level since December. That signaled a widespread return of confidence, a diminished perception of immediate market risk.
Okay, so stocks soared. What about the bond market? I imagine that reacted just as dramatically to the idea of lower rates coming sooner.
It certainly did. The U.S. bond market also responded dramatically. A strong buying spree there. Long-term bond prices rebounded sharply. This caused the yield on the benchmark 10-year Treasury note to fall by 0.08%, down to 4.25%.
Okay.
Shorter-term bonds, like the 2-year note, saw even stronger buying. Their yields dropped by 0.10% down to 3.69%. This was a direct, powerful consequence of the increased certainty or perceived certainty of lower interest rates. Investors were rushing to lock in those higher yields before expected Fed cuts might reduce them further. The FedWatch tool, which tracks these probabilities, it showed the chance of a September rate cut climbing right back up. From 75% back to over 80%, reflecting this renewed conviction among traders.
Now, this next piece of the puzzle is quite something. Here's where it gets really interesting for me. Everyone just loved what Powell said. U.S. stocks were soaring. But why did the Japanese yen get stronger? Especially when the U.S. economy, or at least the market's view of it, was looking so good. Isn't a stronger dollar usually what happens when the U.S. looks robust and attracts global capital?
That's a very perceptive question. And it highlights a crucial nuance in global currency dynamics that often confuses people. You're absolutely right that a strong U.S. economy can often lead to a stronger dollar,
Right.
as it attracts investment-seeking growth and higher returns. However, in this specific instance, the primary driver for the yen's appreciation wasn't necessarily U.S. economic strength in isolation. It was rather the fall in U.S. long-term interest rates prompted by Powell's dovish pivot.
Ah, okay. So it's really about the interest rate difference, the differential, not just the raw strength of the economy itself.
Exactly. Precisely. When U.S. long-term interest rates decline, it makes dollar-denominated assets like U.S. Treasury bonds relatively less attractive compared to assets in other currencies, even if the general mood in equities is risk-on, meaning investors are buying stocks.
Okay.
This effect becomes particularly pronounced as the Japan-U.S. interest rate differential narrows. While U.S. rates are falling on these rate cut expectations, the Bank of Japan, as we'll discuss later, is actually contemplating raising rates, or at least maintaining a tightening bias.
Ah, okay. Opposite directions.
Exactly. This divergence in monetary policy, one central bank easing, the other holding firm or tightening it, triggers dollar selling and yen buying, despite the overall bullish sentiment in global equities. So you had U.S. stocks soaring on the hope of lower rates and the yen strengthening because those very rate cut hopes were narrowing the yield advantage of holding dollars over yen. The yen closed strongly against the dollar that day at 146.8595 yen per dollar. That's a significant appreciation of 1.50 yen for the yen in just a single day.
Wow. That's a really important distinction for understanding how these global markets interact. So while the market was clearly thrilled, euphoric even, I'm always curious about the folks who look a bit deeper, the seasoned experts. What were they saying? Were they all on board with this dovish pivot, or were there some, cautious voices raising red flags?
That's where it gets particularly insightful, because it really reveals the underlying tensions, maybe potential vulnerabilities. While market euphoria was widespread, immediate, the expert opinions were far more nuanced. They revealed both optimism for the short term, but also significant underlying concerns for the long term.
Tell me more about that range of views. What were the optimists saying?
Well, on the optimistic side, you had analysts like Brett Kenwell of E-Trade. He saw strengthening conviction for rate cut resumption. His view was that this would create a favorable situation for stock investors, especially if personal consumption and corporate profits remained robust, sort of a Goldilocks scenario.
Okay.
Steve Sosnick of Interactive Brokers, he echoed this sentiment, called it good news to drive buying. He even suggested it might alleviate concerns about the administration threatening the Fed's independence, interestingly. Their perspective was essentially, the Fed blinked, signaled flexibility, and now it can get back to market growth. Phew.
That sounds like a big sigh of relief for the market players, for sure. But I imagine not everyone was so convinced that this was, an unadulterated positive development. Were there critics?
Indeed. There were quite a few cautious, even critical views that pointed to potential missteps or risks down the road. Pollock Garvey of ING, for example, he noted Powell's speech attempted to balance, upside inflation and a slowdown in the labor market, trying to walk that line.
Right.
However, Garvey found Powell's explicit emphasis on rising unemployment risks somewhat, unexpected, especially given that previous FOMC minutes had consistently shown most participants were actually more concerned about persistent inflation. This unexpected focus on unemployment, while certainly a factor the Fed considers, it heightened the possibility of a September rate cut in Garvey's eyes, yes, but it also raised questions about the Fed's consistent messaging and maybe shifting priorities.
So it wasn't just a simple shift, but maybe a surprise in what he chose to emphasize, indicating perhaps a new worry-taking precedence.
Exactly. That's a good way to put it. And Adam Posen, over at the Peterson Institute for International Economics, he was even more direct, more critical. He flat out called a September cut a mistake, said there was a real risk of rate hikes coming back within 6-8 months, suggesting the Fed would have to reverse course pretty quickly.
Wow, a mistake. Why?
Posen argued that the labor market is actually stronger than Powell implied. He said there are no signs of mass layoffs that would warrant such a sharp dovish pivot right now. He also pointed to persistent tariff-induced inflation as a major ongoing concern. He projected an 85-90% pass-through of those tariff costs to end consumers, with inflationary pressure steadily rising through Q2 2026.
Tariffs again.
Yes. It's a stark warning against premature easing, suggesting it could actually exacerbate inflation down the road, making the Fed's job harder in the long run.
Okay, so even though the market cheered wildly, some serious experts are saying, hold on, this could be a big mistake. And let's talk about political pressure. Does that mean the Fed might not be truly independent anymore? What are the implications of that for future policy decisions, for market stability? That sounds concerning.
This is one of the most fundamental and, yes, concerning issues to emerge from the whole discussion around Jackson Hole.
Oh.
The independence of the central bank. UC Berkeley's Emi Nakamura and Chicago's Raghuram Rajan both voiced serious concerns. They worried about the Trump administration's pressure potentially undermining the Fed's credibility and, by extension, its independence. Nakamura highlighted the immense difficulty of building trust in central banks and the ease with which it can be lost. She suggested this kind of political pressure makes it harder for the Fed to maintain that trust, potentially reducing its policy flexibility long term. Rajan went further, stating that the Fed behaving like opposition is unjustifiable, implying that even if the administration has legitimate concerns, the Fed should not be perceived as a political tool or influenced by partisan agendas. Its mandate is economic, not political.
So it's not just about one rate cut, one speech. It's about the very institution itself, its long-term integrity.
Precisely. The perceived erosion of central bank independence can have profound, far-reaching long-term consequences. When markets lose trust in a central bank's autonomy, it can lead to higher long-term interest rates despite policy cuts, simply because the market demands a premium for the increased uncertainty, the potential for politically motivated decisions.
Right. A risk premium.
Exactly. It can also make inflation targets less credible, which means if inflation resurges, the Fed might need to take more drastic, potentially more painful measures to bring it back under control later. For you, the listener, this means the Fed's future path is heavily data-dependent, yes, but also increasingly vulnerable to these external pressures. Predictions for this year's rate cuts now range from 1 to 3, depending on how employment and inflation trends actually unfold. This uncertainty bubble, fueled by geopolitical and political factors, persists, and its long-term impact on market stability and the Fed's ability to act objectively is a major ongoing concern we need to keep watching.
The semiconductor story. AI's roller coaster and geopolitical undercurrents.
That's a sobering thought indeed, and definitely something worth keeping a close eye on. Okay, shifting gears a bit from monetary policy, let's talk about the tech sector, specifically semiconductors. They seem to be on an absolute roller coaster right now. NVIDIA, of course, is at the very center of so much of this. What's the latest in their incredibly complex world?
The semiconductor sector is, without a doubt, a crucial and often very volatile barometer. It reflects both technological advancement and that intricate dance of geopolitical tensions. And NVIDIA is absolutely at its core, a company caught right in the crosscurrents of innovation and international politics. We've seen two quite contrasting stories emerge just this past week that perfectly illustrate NVIDIA's incredibly complex position.
Okay, give me the good and the maybe challenging aspects of this situation. Where are the pressures and where are the wins?
Right. On the challenging side, we saw Advantest stock fall 2.6%. Advantest is a major semiconductor testing equipment maker, closely linked to NVIDIA.
Okay, why did it fall?
It fell due to concerning reports indicating that NVIDIA had instructed some of its parts suppliers to halt production operations, specifically related to its China-specific AI chip, the H20.
Ah, the H20, the one designed to comply with earlier restrictions.
Exactly. This halt is a direct, immediate consequence of ongoing U.S.-China trade tensions and evolving export restrictions. It vividly demonstrates how quickly geopolitical mandates can impact tech supply chains and a company's ability to operate in critical large markets like China.
Okay, so that's the impact of trade restrictions biting. What's the more positive or, shall we say, globally significant news for NVIDIA, or at least for broader AI development efforts?
On the more positive and globally significant side, we saw Fujitsu stock surge. It hit a 25-year high, up a remarkable 3.03%.
Wow, 25 years. Why?
This came after Riken, which is Japan's largest and most prestigious research institution, announced NVIDIA's participation in developing the Fugaku Next-T supercomputer successor.
Fugaku Next-T, okay.
Fujitsu will handle the system design and the CPU development for this groundbreaking machine, but Riken and NVIDIA will jointly develop the highly specialized, AI-focused GPUs that will power its advanced capabilities.
What's fascinating here is, so NVIDIA halts production for one chip because of U.S.-China tensions, but then they're essential for building a new allied supercomputer. It sounds like they're playing both sides of a very, very high-stakes game. What does this mean for the future of AI development, especially with these ever-present geopolitical restrictions looming?
It absolutely does feel like NVIDIA is navigating an incredibly narrow, almost perilous tightrope, playing a high-stakes game where innovation, economics, national security, they're all completely intertwined. This dual nature, it just underscores their indispensable, almost monopolistic role in cutting-edge AI development, even as they are simultaneously constrained by export restrictions in specific politically sensitive markets.
Right.
GPUs are fundamentally critical for accelerating AI computations. They are the absolute engine behind most modern AI, enabling the processing of vast data sets at incredible speeds. The decision to incorporate dedicated NVIDIA GPUs in Fugaku NXT, unlike the previous Fugaku model, which relied mainly on Fujitsu's own CPUs, reflects a global recognition. To maximize AI capabilities, you need this specialized, high-performance hardware.
Okay.
So, while U.S. policy aims to limit certain advanced technologies from reaching strategic adversaries, it simultaneously encourages and relies on companies like NVIDIA for its own and allied nations' AI advancements. This means the future of AI development will be a complex, delicate dance between pure innovation, overwhelming global demand, and the ever-shifting sands of geopolitical realities. It forces companies like NVIDIA to constantly adapt their strategies really in real time.
That makes profound sense. It's a tightrope walk for sure. And speaking of the U.S. government's role in this strategic industry, I heard something about the HHPS Act getting even more involved than just, offering subsidies. It sounds like a much deeper intervention is being planned.
You're right. We are indeed seeing the U.S. government take a much more active and arguably interventionist role in shaping the domestic semiconductor landscape. The Wall Street Journal reported on the Trump administration's plan to actually acquire shares of semiconductor companies in exchange for subsidies provided under the CHPS and Science Act.
Acquire shares, like stock. That's a pretty direct approach, almost like the government taking an equity stake in private companies. Who would be targeted by this and who might be exempt?
The policy seems quite specific in its targeting, based on the reports. Firms that are already demonstrating a strong commitment by significantly expanding their investment in U.S. production facilities. Think of the Taiwanese foundry giant TSMC or memory chip maker Micron Technology. They will reportedly be excluded from these stock acquisition demands.
Okay, so if you're already building big here, you're okay.
That seems to be the idea. However, companies like Intel, which is currently undergoing a massive restructuring, is considered strategically vital, but has faced some challenges, could see the U.S. government acquire a substantial 10% stake in exchange for subsidies. Interestingly, this news alone, when it broke, actually sent Intel's stock 5.5% higher, indicating that investors perhaps saw the government backing as a positive, albeit unconventional development. Maybe a sign of support.
So it's essentially a way to encourage crucial domestic investment while also potentially giving the government a direct stake in the success, maybe even the strategic direction of these key companies.
Precisely. This policy represents a powerful demonstration of the government's active role. It aims to balance investment incentives with direct equity demands. The goals are clear: promote domestic production, enhance supply chain resilience, and ultimately achieve technological sovereignty in this critical industry. It's a clear signal the U.S. is serious about bolstering its semiconductor capabilities, even if it means blurring the lines between public and private enterprise in pursuit of national strategic goals. Historically, governments have often played a direct role in strategic industries during times of national importance, like wartime. This could be seen as a modern-day equivalent in the global tech race.
That's a very clear strategic play, blurring those lines. Okay, let's zoom in on Japan for a moment and how this insatiable global demand for AI is playing out on a company-specific level there. I saw something about Soccer and Net making a huge investment, which sounds like a direct response to this demand.
Indeed. Sacronet, a prominent Japanese data center company, provides a concrete, very tangible example of this surging demand for AI infrastructure in action. Their stock rose 3.3% after they announced they would borrow a substantial 13 billion yen, that's roughly, $88 million from a consortium of banks.
That's okay. And the purpose?
The purpose: to procure a significant number of NVIDIA GPUs and all the related equipment for their data centers, like their key Ishikari data center. This highlights a direct, significant, and frankly urgent investment into acquiring that cutting-edge AI computing power.
Wow, 13 billion yen just for GPUs and related gear. That's a substantial commitment. Was this seen as a positive move by investors, especially considering, how competitive data centers are?
It was overwhelmingly seen as positive.
Yeah.
And it really underscores the power of this AI demand narrative right now. Even though Sacronet had recently revised downward its consolidated earnings forecast for the fiscal year ending March 2026, due to completion of some major projects and other operational factors. This announcement of a massive AI investment was met with immediate investor optimism.
Yeah.
They saw it as a critical strategic move to enhance competitiveness in the fiercely competitive rental services market, especially for those highly coveted offerings that provide GPU capabilities. It demonstrates how powerfully investors are willing to back companies that make bold moves to capitalize on the AI boom, even if other parts of the business face headwinds.
That really shows where the market sees the future growth. And speaking of NVIDIA, they have a massive earnings report coming up very soon, don't they? August 27th. It feels like the entire tech world, maybe the whole market, holds its breath for that one.
Absolutely. NVIDIA's Q2 earnings, scheduled for August 27th, are a hugely anticipated event. For the entire tech sector, for global markets, the expectations are sky high, reflecting that unprecedented demand for AI chips we just discussed. Market forecasts compiled by QuickFactSet anticipate a robust 53% year-on-year increase in revenue and an impressive 44% rise in net profit, driven almost entirely by that strong AI demand.
Wow.
But it's not just about the numbers achieved. It's really about the future guidance they provide. What do they see coming next?
Okay, so on one hand, we have companies like Sacranet investing heavily in NVIDIA's GPUs, showing this huge, undeniable demand. It's real. On the other hand, there's all this geopolitical tension around NVIDIA's China business, with production halts for chips like the H20, reports of potential exclusions. How do investors even begin to weigh these things when a company's success seems to depend on so many volatile, really unpredictable moving parts?
This is truly the uncertainty bubble in action, and it creates inherent volatility, significant risk for investors trying to value a company like NVIDIA. On one side, you have the undeniable, almost insatiable, robust demand for AI chips. That's a powerful, very real growth engine for NVIDIA's fundamental technological shift, driving massive spending. You can't ignore that.
Right. Huge tailwind.
Huge tailwind. But on the other side, you have the highly unpredictable political and regulatory risks stemming from U.S.-China tensions. That H20 production halt we mentioned, coupled with reports that Chinese authorities are actively showing intent to exclude NVIDIA products from certain government or state-linked procurements.
Yeah.
That casts a substantial shadow over what was a very lucrative China market for them.
Okay.
Investors are essentially balancing this incredible, almost assured growth potential against geopolitical headwinds that can shift rapidly, unpredictably, and often with very little warning. The upcoming NVIDIA earnings call isn't just about the financial figures from the last quarter. It's a critical moment for the company to articulate its strategy for managing these complex global pressures, to reassure the market about its future trajectory.
So what they say about the future is almost as important as the numbers.
Exactly. Management's commentary during that briefing, especially on their China strategy, alternative market development, supply chain resilience, it will be scrutinized very, very closely for any insights into how they plan to navigate this dual challenge. It's a high-wire act indeed, a very public one.
That makes perfect sense. It's like trying to predict the weather while you're standing in a hurricane. You know, there's a lot of power there, but the exact direction is anyone's guess. And this brings us to a rather provocative market theory I saw mentioned. The last dance of high-tech stocks. What's that all about? That sounds a bit ominous. Should we be worried?
This theory, suggested by market analyst Yoichi Nagai from NQN, is quite provocative indeed. And it certainly gives investors pause. Makes you think. It posits that the current surge in U.S. high-tech stocks might actually be a last dance, a final, maybe exuberant burst of enthusiasm before a significant market shift. Perhaps even a broader downturn, or at least a prolonged period of underperformance for this sector that has led for so long. This theory points to observed sector rotation as a key indicator of this potential inflection point.
Sector rotation. What kind of rotation are we talking about? And why is that considered a red flag in this context?
Specifically, Nagai noted a subtle but significant rotation of capital away from the large-cap tech giants towards smaller and medium-sized stocks. For instance, in the immediate aftermath of Powell's dovish speech, the Russell 2000 index, which comprises smaller, often more domestically focused, sometimes more interest-sensitive companies, rose a notable 3.9%.
Okay.
Meanwhile, the tech-heavy NASDAQ composite increased by a comparatively modest 1.9% on the same day.
Smaller stocks did better.
Right. This pattern, where smaller cap stocks or value stocks see late-stage gains or outperform large-cap growth stocks, is eerily reminiscent of the period leading up to the 2000 IT bubble collapse.
Oh, wow. Okay.
Back then, investors, perhaps sensing a potential slowdown or recession despite rate cuts, would often shift funds from those overvalued tech darlings to smaller, more traditional companies, hoping for some extra gains before a potential broader market downturn. It's the financial equivalent of maybe a warning label hidden on a glittering party invitation.
So it's a historical parallel that suggests a market nearing its peak, with capital starting to seek new, maybe safer, or just different havens. What are the underlying factors driving this last dance theory right now, according to the analyst?
Nagai points to several contributing factors that create this potentially fragile environment. First, we're seeing a slowing in non-farm payroll growth and also a declining labor force participation rate. This latter point, the participation rate, is significantly influenced by reduced immigration, which is, in part, a consequence of policies implemented during the Trump administration. This demographic shift fundamentally hinders economic growth potential by limiting the available workforce.
Right. Fewer workers, potentially slower growth.
Exactly. The Congressional Budget Office, for example, estimates that immigration cuts alone could reduce 2025 GDP growth by 0.3 to 0.4 percentage points. That's not trivial.
That's a pretty direct link between a specific policy and the broader economic impact, extending far beyond just the immediate political talking points.
Absolutely. It has real macroeconomic consequences. Another significant factor contributing to this precarious market environment is the persistently high U.S. economic policy uncertainty index. It currently stands at a striking 294.54 in August, which is far, far above its 40-year average of around 114.
Wow, that high.
Yes, this elevated uncertainty makes companies hesitant. They hesitate to commit to long-term investments, and instead, they often funnel excess cash into financial markets, stock buybacks, dividends temporarily propping up stock prices. The last dance theory suggests that while potential Fed easing might offer a temporary boost, a sugar high perhaps, the underlying economic fundamentals and these pervasive policy uncertainties are setting the stage for a significant turning point, a turning point in market leadership, maybe in overall valuation levels.
This raises an important question. A last dance for high-tech stocks. That does sound a bit dramatic, but if there's truth to it, what are the red flags we should be watching for? And what does it mean for you, the learner in our audience who might be looking at tech investments right now? Should they be worried?
It does sound dramatic, maybe overly so, but it's a theory that encourages critical thinking about the sustainability of current market rallies, which is always valuable, right?
Definitely.
For you, the learner, the red flags to watch for include a sustained shift in sector leadership, not just one day or 1 week. This means observing if capital consistently flows away from the large-cap tech giants towards smaller, more value-oriented, or even traditionally defensive stocks over an extended period.
Okay, look for a persistent trend.
Exactly. Pay close attention to whether the fundamental economic data, particularly employment figures, wage growth, inflation trends, truly align with the narrative of a robust, self-sustaining recovery. Or if they continue to show signs of underlying weakness, persistent cost-push inflation, like from tariffs, or decelerating growth. Furthermore, closely monitor geopolitical developments and central bank commentary beyond just the headlines. Is that uncertainty bubble actually deflating, or are new risks popping up on the horizon? The core message here is, even with potential rate cuts, the affordability of historically overvalued U.S. stocks remains a significant concern. The uncertainty bubble fueled by policy unpredictability might persist, but it cannot indefinitely defy underlying economic fundamentals or historical market cycles. So don't just follow the crowd into whatever is soaring today. Look for the concrete data, the long-term trends that either support or contradict the current market narrative. And always consider the potential for alternative scenarios. Be prepared.
Japan's economic landscape, inflation, innovation, and old guard challenges.
That's incredibly valuable advice for navigating what sounds like a very, very tricky market environment ahead.
Okay, let's shift our gaze across Pacific now to Japan. Japan seems to be charting a rather unique, often counterintuitive course compared to the U.S. The Bank of Japan's stance, especially after Jackson Hole, seems to diverge quite a bit from the U.S. Fed's dovish pivot we just discussed. What's happening there, and how is it impacting the Japanese economy?
Japan is indeed on a significantly divergent path compared to the U.S., and it's a fascinating study in macroeconomic policy, really. Decades in the making. While the U.S. Fed is hinting at easing, Bank of Japan Governor Ueda, also speaking at Jackson Hole, reinforced the impression that the BOJ intends to maintain a rate hike path, or at least a tightening bias in the near future.
Rate hikes, still.
Yes. He specifically stated that wages continue to face upward pressure domestically. This is a strong signal that the BOJ believes it is finally achieving its long-sought goal of sustainable inflation, driven by wage growth, making rate hikes a logical next step in their view. So, Japan is still laser-focused on rising wages and potential rate hikes. Almost the complete opposite concern to the U.S. Fed right now, which is worried about employment weakening.
Exactly. It's quite the contrast. This conviction was further bolstered by the Consumer Price Index data for July, released just on August 22nd. The core CPI, which strips out volatile fresh food prices, it actually exceeded market expectations, came in higher than anticipated.
Okay.
This immediately heightened speculation among economists, among traders, of an early BOJ rate hike, possibly as soon as their next policy meeting.
And what was the immediate market impact of that divergent policy outlook if the U.S. is cutting and Japan is hiking?
The divergence in monetary policy expectations, U.S. potentially cutting, Japan potentially hiking, had tangible, immediate effects across Japanese financial markets. The yield on newly issued 10-year Japanese government bonds, the JGB, which is a benchmark for long-term rates, temporarily reached 1.615%. That's a significant 17-year high.
Yeah.
This contrasting policy direction is generally expected to strengthen the yen, with some analysts predicting it could move beyond 140 yen per dollar as that interest rate differential with the U.S. narrows further. However, it's worth noting, substantial yen gains might be capped if the U.S. stock market remains very strong, because that tends to favor global risk-on sentiment, which can sometimes mute the pure currency impact of rate differentials.
I understand. So Japan is heading in the opposite direction from the U.S. on interest rates, trying to encourage inflation after decades of fighting deflation. But what does sustained wage growth pressure actually mean for people in Japan, for the average person? Will it feel good, like they have more money? Or will prices keep rising faster than wages, making them actually feel poorer?
That's the critical question for the average household in Japan, because nominal growth doesn't always translate directly into a better real quality of life, right?
Right. What you can actually buy.
Exactly. What we're currently seeing in Japan is a fascinating dynamic. Nominal GDP growth, the total value of goods and services, was a robust 5.1% in Q2 2025. But real GDP growth adjusted for inflation, the actual volume stood at a much more modest 1.0%.
Okay, big gap. So the economy is growing mostly in terms of the amount of money being exchanged, the overall value of transactions, but not necessarily in the volume of goods and services produced or consumed.
Precisely. That substantial gap indicates that inflation is the primary driver of the nominal economic expansion. For companies, this can be largely beneficial. Their sales have risen significantly from an index of 105 in fiscal year 2021 to 116 in fiscal year 2023, largely because they can successfully raise selling prices to cover higher costs and improve profitability.
Good for profits.
And the government also benefits from this nominal growth, seeing tax revenues exceed forecasts, which helps to shrink the primary deficit. That's the difference between government revenues and expenditures, excluding debt service costs. However, for households, the situation is much more complex, often feels challenging. If wage growth, even if it's sustained, doesn't keep pace with, or ideally outpace, the rising cost of goods and services, it can lead to a feeling of shrinking real incomes, eroding purchasing power, even amidst a backdrop of positive nominal economic expansion and positive headlines. So while sustained wage growth pressure is a positive sign for the BOJ achieving its inflation target, its real impact on people's wallets depends entirely on whether those wage increases are truly sufficient to stay ahead of, or at least match, the rising prices they face every single day. It's a really tricky balance between those macro goals and the micro realities on the ground.
That paints a much clearer picture. It's a delicate and often personally quite painful balance.
Okay, beyond these big macro-level policies, what's happening at the company level in Japan? Are there any interesting corporate maneuvers or innovations reflecting how businesses are adapting to this changing environment?
Absolutely. We're seeing a lot of strategic activity from Japanese companies across various sectors, showcasing both innovative strategies and direct reactions to these market pressures and opportunities. For example, SBI Holdings is making significant, quite bold moves in the financial sector. Their stock rose 2.94% after officially announcing a capital and business alliance with Tohoku Bank, acquiring up to a 2.95% stake.
Okay, SBI expanding again.
Yes. This move continues SBI's ambitious fourth megabank concept, which aims to consolidate and digitize regional banking by bringing its total regional bank partnerships now up to 10. The goal is to provide SBI Group's advanced financial services, asset management, digital tools, and support digital transformation, or DX, for these regional banks, tapping into new growth engines in a traditionally fragmented sector. That's a very bold, almost disruptive strategy for traditional banking there. What about other sectors? I heard about Aichi Steel making waves. What's happening there?
In the manufacturing sector, yes, Aichi Steel. It's a key part of the venerable Toyota Motor Group. Its shares have actually doubled since the beginning of the year.
Doubled. Wow.
Doubled, nearing its price-to-book ratio, or PBR, target of 1x. PBR is a key valuation metric comparing a company's market value to its book value on the balance sheet. This surge is fueled by intense market speculation that it could be the second Toyota Industries to go private, following a similar move by another Toyota affiliate.
Okay. Going private buzz.
Exactly. Aichi Steel has a history with activist shareholders pushing for change and extremely close ties to Toyota's origins, making it an attractive target for investors seeking those kinds of opportunities for value unlocking, maybe through restructuring or privatization.
Interesting. And on the infrastructure and energy side,
Yeah.
any notable strategic shifts happening there? Kojima, maybe?
Yes. We also saw Kojima's stock hit a year-to-date high. This was after reports confirmed its strategic withdrawal from an offshore wind power project consortium. They were partners with Mitsubishi Corp. And Chubu Electric Power.
They pulled out of offshore wind. Why?
The decision to exit was driven by unprofitability, primarily due to soaring construction costs that just made the project financially unviable for them. However, investors viewed this seemingly negative news pulling out of a growth area positively. They saw it as a decisive move by management to prioritize earnings, maintain financial discipline. It demonstrated a willingness to cut losses on challenging high-risk projects rather than throwing good money after bad, a sign of prudent management.
That's a very decisive move, valuing profitability over maybe just sheer scale or chasing trends. Any other notable corporate news signaling ambitious growth? ASICS, maybe?
Yes, ASICS, the sportswear company, also drew significant attention. This was after its president, Mitsuyoshi Tamanaga, announced an ambitious new midterm management plan. They're aiming for at least 1 trillion yen in consolidated sales by FY December 2029, and an impressive 20% operating profit margin.
Wow, 1 trillion yen. That's a big target.
It is. It signals very aggressive growth expectations, particularly from their premium brands like Onitsuka Tiger. It highlights a strong drive for significant expansion and market share gains in the highly competitive global sportswear market. It's a clear declaration of intent to grow significantly.
Okay, so we're seeing some really big strategic moves here, like SBI building this fourth megabank concept, Aichi Steel getting the tech and Toyota Industries buzz, Kojima pulling back, ASICS aiming high. What's the common thread here? Is it all about consolidation and finding new growth engines in a changing market? Or is there something more fundamental going on?
You've hit on the core insight perfectly there. The common thread across these diverse corporate actions is indeed their dynamic response to a rapidly changing, often challenging economic environment in Japan and globally. It's all about navigating profound shifts, whether that's through strategic consolidation like SBI, disruptive innovation, or a pragmatic reevaluation of core business strategies for optimal shareholder value, like Aichi Steel or Kojima.
Okay.
For SBI, it's about traditional financial institutions leveraging expertise in asset management and digital transformation to remain competitive and expand their reach into underserved regional markets, essentially building a new kind of interconnected financial ecosystem. For IDD Steel, it reflects how large corporate groups, especially those with activist shareholders pushing for change, are under increasing pressure to unlock value, sometimes through drastic measures like reprivatization to focus on long-term growth away from short-term market pressures. And Kojima's decision highlights the necessity for construction and engineering firms to make tough profitability decisions in new complex sectors like renewable energy, demonstrating a pragmatic shift towards financial discipline, towards risk management. Each of these companies, in its own way, is aiming to ensure long-term growth and competitiveness, adapting to a market where traditional models are constantly challenged and new opportunities or indeed new risks are constantly emerging. It's really a period of intense corporate evolution in Japan.
That's a great distillation. It shows a very dynamic side of corporate Japan adapting and evolving. But then we have contrasting and frankly quite challenging narrative with Japan Post. It sounds like a business model really struggling to adapt, almost a microcosm of stagnation in certain areas, as you hinted earlier. What's going on there? It seems like such a different story.
You're absolutely right to call it a microcosm of stagnation, and it stands in stark contrast to the dynamic corporate stories we just discussed. It's a very different picture. To truly understand Japan Post's enduring struggles, it's actually helpful to first look at a parallel example, like Singapore Post, Singpost. They're facing similar, though perhaps less entrenched, headwinds. Singpost recently reported a significant 60% drop in operating profit for the April-June 2025 period. International delivery revenue down 59%, e-commerce services down 63%, all due to intensified competition, shifting consumer habits.
Okay, so global pressures on postal services.
Exactly. It illustrates the global headwinds facing traditional postal services everywhere in the digital age. Now, Japan Post is facing similar pressures, yes, but compounded by its unique history, its massive scale, and maybe institutional inertia.
So Japan Post problems are even deeper, perhaps, and longer lasting.
Even more so, and for a much longer period. 20 years now after its ambitious privatization initiative began, Japan Post continues to face profound, almost existential challenges. Its core mail volume has effectively halved over the past 2 decades, down to just 12.5 billion items annually, a direct casualty of email, messaging, digital communication.
Wow, halved.
Yes. The company still relies heavily on public funds, indirectly perhaps, and has been plagued by a series of high-profile scandals. Things like inadequate driver roll calls that led to administrative penalties, which erode public trust. Its core parcel delivery business, UPAC, is under immense pressure. Customers reportedly refraining from using the service due to quality concerns, rising prices, and just fierce competition from nimbler private players like Yamato and Sagawa.
That sounds like a business model truly struggling to adapt to the digital age, facing disruption on absolutely multiple fronts.
Precisely. Moreover, Japan Post reported profits. The profits they do report heavily rely on its 2 giant financial subsidiaries, Yucho Bank and Kampo Life Insurance.
The bank and insurance arms.
Exactly. This is despite initial privatization goals that aim to fully divest these units to force the Postal Service to stand on its own commercial feet. That hasn't happened. The company's attempts at growth-oriented investments outside its core business have repeatedly failed, exemplified most starkly by the over 400 billion yen impairment loss from its ill-fated acquisition of the Australian logistics firm Toll Holdings. Disaster.
Ouch, over 400 billion yen lost.
Yes. Even hoped-for real estate ventures, which might have seemed like a safe bet given their property holdings, they largely fell through or didn't deliver.
So they're basically depending on these legacy financial assets and even unsuccessful overseas investments rather than finding a genuinely new path for their core postal services.
Yes, that's the unfortunate reality. This heavy reliance on overseas investments, like its significant stake in the U.S.-based insurance company Aflac Incorporated, for a significant portion of its profits is particularly telling. It highlights a profound struggle for domestic growth, for innovation within its core operations, and it's often seen, quite accurately I think, as a microcosm of stagnant Japan.
This situation reflects broader challenges facing the nation: population decline, a rapidly aging society, and a corporate culture that has often been slow, maybe too slow, to adapt to disruptive technological shifts. Globally, postal services are struggling with digitalization. Denmark, for instance, abolished universal service obligations entirely in 2024 as letter volume dropped over 90% in 25 years. Germany's privatized postal firm, Deutsche Post DHL, is actively cutting 8,000 jobs. Japan Post's situation, while unique in its scale and history, is not unique in its fundamental challenges. But perhaps it's unique in its enduring reliance on government support and those financial arms, despite 2 decades of privatization attempts. This story about Japan Post is such a contrast to the dynamic tech and banking news we just heard. It really sounds like a massive business model struggling profoundly to adapt to the 21st century. What can you, the learner listening to this, take away from Japan Post's 2-decade struggle? What might apply to other traditional industries facing similar disruption?
Well, what Japan Post's journey powerfully highlights for other traditional industries is that immensely difficult, often painful balance. The balance between maintaining universal service obligations, often a legacy of their public origins, and achieving genuine commercial viability in a rapidly digitalizing, fiercely competitive world.
Right. That public service mission versus commercial reality.
Exactly. We learn the profound dangers of failed growth investments, where a lack of strategic foresight, rigorous due diligence, or effective execution can lead to massive, value-destroying losses, as starkly seen with Toll Holdings. It's a reminder that simply throwing money at new ventures isn't a strategy. Smart, well-executed investments are. It also underscores the perils of over-reliance on legacy assets. In Japan Post's case, it's highly profitable financial subsidiaries. While generating income, they can distract management from the fundamental need to innovate, to find new, sustainable revenue streams for the core struggling business.
Complacency risk.
Precisely. Furthermore, A deeply entrenched bureaucratic culture can stifle the necessary innovation, the agility, the risk-taking required to compete effectively against nimbler private sector players. It's a cautionary tale about the necessity for fundamental, perhaps even painful, transformation rather than just incremental adjustments when faced with existential disruption. For any traditional industry, the crucial question isn't just if you're adapting, but how quickly and decisively can you transform your core operations, your culture, before the disruption becomes insurmountable and your relevance just fades away.
That's a powerful and, frankly, timeless lesson for any established business. Okay, and on a completely different note, but one that brings the economy right down to our everyday lives. What about some of the more unexpected domestic economic indicators in Japan? I'm curious how these ground-level stories, like something about carrots or maybe even golf, fit into the bigger economic picture and that whole inflation narrative we discussed earlier.
These are excellent examples because they show how localized events, far from the central bank boardrooms, can ripple through the broader economy and affect household budgets directly. First, let's look at Hokkaido's agricultural woes. Hokkaido, the northern island, it accounts for a substantial 14% of Japan's total agricultural output. It's a breadbasket or maybe vegetable basket for Japan. It's currently experiencing a poor carrot and potato harvest. Intense heat and unusually low rainfall since early summer have severely reduced crop yields across the region.
Okay, climate impact right there.
For sure.
So if the supply is down, I imagine prices are going up for consumers at the supermarket.
Precisely. Wholesale prices for carrots, for instance, are already up by 30% compared to last year, and shortages are expected to continue well into autumn and winter. Other key vegetables, like tomatoes and onions, are also significantly affected. This is a direct illustration of how global climate change manifesting in local weather patterns directly impacts agricultural supply chains and household food budgets. It contributes to broader inflationary pressures for everyday necessities.
Right, food inflation.
It's a clear example of what we call cost-push inflation, where costs rise due to supply-side factors, in this case, weather and climate.
That's a stark reminder of the real-world, tangible impact of climate on our economy. What's a contrasting story you mentioned on the demand side? Something about golf memberships that seemed quite different.
On the other hand, yes, we're seeing an unexpected and quite robust boom in golf membership sales and prices. Prices for golf memberships in the Kanto region, which includes Tokyo, are currently at a 15-year high.
15 years. Why the boom in golf?
It's driven by a few key factors, it seems. Renewed popularity post-COVID as people sought safe outdoor activities, a general health-conscious trend among a segment of the population, and very strong corporate entertainment demand, particularly for the high-price tiers, the really exclusive clubs, some memberships exceeding 10 million yen for entry that's over $65,000. This indicates where discretionary spending power is concentrated: wealthier individuals, corporations.
Okay, so from carrots costing more due to bad weather to expensive golf courses seeing booming demand and price hikes, it's not just big global policies affecting us, right? How do these ground-level stories connect to the bigger picture of Japan's economy and inflation that the BOJ is watching? Well, if we connect this to the bigger picture, these local stories powerfully demonstrate that inflation isn't solely a monetary phenomenon driven just by central bank policies or global trade flows. It also has very significant supply-side components like the carrots and demand-side components like the golf memberships that are often overlooked in broad analyses.
The Hokkaido carrot example shows how environmental factors, like climate change, directly impact the cost of essential goods, leading to that cost-push inflation that hits everyone's food budget and feeds directly into the broader CPI figures that the Bank of Japan is watching so closely. Conversely, the robust demand for high-end golf memberships, driven by affluent individuals and corporations, shows where spending power is concentrated within the economy. This leads to localized inflationary pressures in leisure and luxury sectors, a form of demand pull inflation. This happens even as other parts of the economy might still face stagnation or struggle. It illustrates how different segments of the economy experience inflation very differently, and how overall economic health isn't a single uniform experience for everyone. It's really a complex tapestry of economic forces at play, where global and local, supply and demand all intertwine to create the overall economic landscape you experience every day.
Broader currents and outlook, tariffs, elections, and the unpredictable future.
That's a fantastic way to put it, a complex tapestry woven from all these disparate threads. Okay, let's broaden our view again as we head towards the end. Let's talk about some of the overarching currents shaping the future, especially the persistent shadow of, well, Trump's tariffs. It feels like this issue just keeps cropping up across different sectors, different countries. It seems to go far beyond simple trade disputes.
It absolutely does, and it's a critical, pervasive influence that has implications for almost every sector we've discussed today. The shadow of Trump's tariffs is an undercurrent that connects many of these seemingly disparate stories. It's not just about trade protectionism in the old sense. It's fundamentally about industrial policy, about international relations, and crucially, it's becoming a persistent source of inflation.
Can you give me a quick recap of how it's showing up in these broader currents? Just pull those threads together for us.
Certainly. In the semiconductor industry, for instance, the Trump administration's reported plan to acquire semiconductor company stocks in exchange for CPS Act subsidies, which we discussed.
Right, the government taking stakes.
That's a direct, almost unprecedented interventionist approach. While it reportedly exempts companies like TSMC and Micron that are expanding U.S. investment, it explicitly targets others like Intel for potential government stakes. This shows a direct link between trade policy, designed to protect domestic industries, and industrial policy, aimed at strengthening national capabilities. It really blurs the lines of traditional free market economics. Then there are the significant international implications, particularly for a country like India. Indian stocks are closely watching the August 27th deadline for a potential additional 25% U.S. tariff on certain goods.
Another 25% on top of existing ones.
Yes. If applied, this would bring the total tariff rate to an astonishing 50% on top of existing duties for those goods. This kind of protectionist move could trigger significant selling pressure in the Indian market, despite Prime Minister Modi's domestic economic revitalization measures like GST cuts. It highlights how quickly one major economy's protectionist policies can destabilize foreign markets, undermine the efforts of other nations. And finally, on the global inflation risk front, economists like Paul Garvey and Adam Posen have consistently warned these tariffs are not one-off events with transient effects. They are designed to be structural, and therefore they can cause mild but potentially persistent inflation.
Persistent inflation.
Yes, Posen specifically projected an 85–90% pass-through of these tariff costs directly to end consumers. He suggested that core inflation could steadily rise from around 3% to 4% or even higher over time. This isn't just a temporary price bump, it's a structural shift that could make the Fed's job of achieving its 2% inflation target much, much harder.
Okay, this tariff issue just seems to keep popping up everywhere, acting like this constant friction in the global system. If these tariffs are indeed causing persistent inflation and significantly affecting global trade and investment decisions, what does that mean for the stability of the global economy, especially with U.S. elections on the horizon, which could potentially solidify or even expand these policies?
It's a significant and pervasive destabilizing force. What it means for global economic stability is a continuation and potentially an intensification of what we've called the uncertainty bubble. Remember the U.S. Economic Policy Uncertainty Index, still significantly elevated at 294.54 in August, vastly exceeding its 40-year average of 114.
Right, still way up there.
Tariffs contribute directly to this uncertainty. They foster an environment where companies delay long-term investments, supply chains are reconfigured at great expense and disruption, and market reactions become less predictable, more volatile. The interconnectedness of global trade ensures that one major economy's protectionist policies have far-reaching, often inflationary consequences. They spill over into other nations, other industries, forcing them to adapt or face serious economic headwinds. With U.S. elections on the horizon, the prospect of these policies becoming more entrenched or even expanding adds yet another profound layer of unpredictability. It makes long-term planning, long-term investment decisions incredibly challenging for businesses and investors worldwide. It's a political risk that has very direct, very global economic consequences.
That's a huge point, that intersection of politics and economics. And this leads us right into another critical theme that implicitly, maybe explicitly, surfaced at Jackson Hole: the issue of political control and the Fed's challenging guidance. How is the institution of the Fed itself being impacted by these broader political currents, and what are the long-term implications of that?
This is a major concern, or perhaps one of the most fundamental, because the credibility, the independence of a central bank are paramount for both domestic economic stability and global market confidence. The Jackson Hole Symposium, as we noted, was seen by many observers as Fed Chair Powell's last as chair, amidst what is described as abnormal pressure from the Trump administration. This pressure isn't just about influencing a single policy decision, like a rate cut. It aims to influence monetary policy and leadership more broadly, potentially leading to artificially low policy rates, the situation sometimes referred to as financial repression, where government influence suppresses interest rates, often to manage its own debt and the fueling of asset bubbles. all potentially for short-term political gains.
So it's about potentially undermining the very structure and mandate of the Fed, not just disagreeing with a specific decision.
Exactly. Prominent economists have been very vocal about this risk. Raghuram Rajan, a former chief economist for the IMF, articulated that the Fed behaving like opposition is unjustifiable. He stressed that while administrations have elected authority, the Fed must remain nonpartisan, focused solely on its dual mandate: maximum employment and price stability. Adam Posen from the Peterson Institute noted that attacks on Fed institutions and expertise undermine trust, implying that even formal independence, written in law, can be gradually eroded by a constant barrage of political criticism and attempts to sway policy decisions. These criticisms highlight growing concerns about the long-term credibility and autonomy of the central bank, which is vital for managing inflation expectations and maintaining market confidence without political interference.
And I heard Powell's remarks on downside employment risks were even linked by some analysts to reduced immigration, which connects directly back to political policy decisions. How does that fit into this complex picture?
It's another fascinating, often overlooked intersection of politics and economics. Powell specifically noted that the labor market balance, while still relatively strong, is maybe barely maintained, partly due to reduced immigration levels. The Congressional Budget Office, as we mentioned, estimates these immigration cuts could reduce 2025 GDP growth by a measurable 0.3 to 0.4 percentage points.
Right.
This illustrates how political policies, such as immigration controls, directly intersect with and can actually constrain monetary policy options. They do this by impacting the fundamental supply of labor and the overall economic growth potential. If the labor supply tightens due to reduced immigration, it creates different inflationary pressures, like wage pressures, and employment dynamics that the Fed must then contend with. It could potentially limit their flexibility to cut rates, even if they wish to stimulate the economy, because a tight labor market could fuel wage inflation. It's a policy dilemma born from a non-economic policy decision.
This is a big one. If the Fed's independence is truly being challenged, maybe eroded, and political agendas start dictating economic policy, what could be the long-term consequences? For things like inflation, for stock market bubbles, and just for general trust in the whole system, both domestically and globally.
The long-term consequences of a perceived erosion of trust in a central bank's independence are profound. They're far-reaching, reverberating throughout the entire financial ecosystem. Firstly, for inflation. If the market believes the Fed is bending to political pressure to keep rates artificially low, its credibility in fighting inflation could diminish significantly. This could lead to a de-anchoring of inflation expectations. People stop believing the Fed will hit its target. That makes inflation much harder to control, potentially requiring more drastic, more economically painful policy shifts down the line to restore price stability.
Okay, harder to fight inflation.
Secondly, regarding stock market bubbles. If policies are driven by short-term political gains rather than sound economic principles, it can indeed fuel asset bubbles. Artificially low rates, combined with the perception of political backing, maybe reduced regulatory oversight, can encourage excessive risk-taking, malinvestment, severe overvaluation, setting the stage for more brutal, more destabilizing corrections when economic fundamentals eventually reassert themselves.
Right. Bigger booms, bigger busts.
Potentially. Finally, for general trust in the system. A loss of central bank independence fundamentally undermines the stability, the predictability of financial markets.
Yeah.
Investors, both domestic and international, rely on the Fed's impartiality, its data-driven approach, to make informed decisions. If that trust is compromised, it can lead to capital flight, higher risk premiums.
Meaning higher long-term borrowing costs.
Exactly. Higher long-term interest rates, despite policy cuts, as lenders demand more compensation for that uncertainty, and just generally increased market volatility. The coming year will be pivotal in determining the future shape, the future independence of the Fed, with significant implications not just for the U.S. economy, but for global financial markets. The market itself may eventually have to correct for politically influenced policies, often in disruptive ways.
That's a truly critical outlook to keep in mind, and definitely something we must all monitor closely. Okay, so bringing all these threads together as we wrap up the Fed's dovish pivot, the tumultuous semiconductor story, Japan's unique monetary path, and these looming uncertainties from tariffs and political dynamics, what's the overall outlook for the markets, especially the Japanese and U.S. ones, as we head into the rest of the year? What should we be bracing for?
Synthesizing these complex, often contradictory dynamics, the outlook is one of, well, cautious optimism mixed with significant underlying risks. It's not a clear path. For the Nikkei average in Japan, driven by renewed U.S. rate cut prospects, which boost global risk appetite, and also expected upward revisions to Japanese corporate earnings. Some analysts are projecting it to reach 44,000, maybe even 45,000 yen by year-end.
Wow, back towards the highs.
If this materializes, yes, it could potentially surpass recent all-time highs, marking a significant chapter in Japan's market resurgence.
And the yen. Will it continue to strengthen against the dollar, potentially impacting those Japanese exporters we talked about?
A yen appreciation is strongly anticipated as a mainstream view now. The consensus expectation is that the Fed will cut rates maybe 2-3 times this year, while the Bank of Japan will likely raise rates once or at least maintain a tightening bias.
The divergence continues.
Exactly. This ongoing divergence in monetary policies is expected to narrow the Japan-U.S. interest rate differential, pushing the yen stronger. Many anticipate it could move beyond 140 yen per dollar. However, this comes with a significant caveat. If the yen strengthens too much, maybe falls below 145 yen per dollar, it could become a notable headwind for Japanese exporters, many of whom have assumed a weaker yen, often around 150-155, in their earnings forecasts. A stronger yen could squeeze their profitability.
Okay, so the balancing act there too. We obviously need to watch a lot of data points very carefully in the coming weeks to confirm these trajectories, right?
Absolutely. Key data to watch includes the U.S. August employment statistics due September 5th, and the crucial U.S. August CPI inflation report expected September 11th. These will either validate or seriously challenge the current rate cut expectations embedded in market pricing right now.
Make or break data points.
Potentially. Domestically in Japan, the August Tokyo CPI, released August 29th, and speeches from BOJ officials like board member Nakagawa on August 28th will provide further clues on Japan's monetary policy trajectory. And of course, NVIDIA's earnings on August 27th remain a key focus for the entire tech sector globally, offering insights into the AI boom's sustainability and those geopolitical impacts.
Okay. What are the biggest risks to this scenario? The base case seems to be simultaneous stock gains and gradual yen appreciation. What could truly disrupt this picture for you, the listener, to be aware of?
There are several primary risks that could derail this relatively optimistic, maybe consensus outlook. Firstly, accelerating inflation in the U.S. If those tariff-induced inflation concerns reignite, perhaps sparked by stronger than expected U.S. August CPI data, it could cause rate cut expectations to waver dramatically, sending markets into a tailspin as they rapidly recalibrate.
Okay, inflation is risk number one.
Definitely. Secondly, domestic political uncertainty in Japan. Discussions around the ruling LDP leadership election, speculation about Prime Minister Ishiba's potential resignation. That could impact the yen significantly. If expectations for expansionary fiscal policies under a new administration grow, it could actually fuel yen selling as investors worry about increased government debt or just a less stable political environment.
Politics impacting the currency again.
Yes. And finally, U.S. stock overvaluation. If U.S. long-term rates were to rise sharply, maybe back above 4.5% due to intensified inflation concerns or a more hawkish shift from the Fed than expected, the appeal of stock yields would diminish substantially. That could trigger widespread stock selling as bonds suddenly become a much more attractive, safer alternative. These are all powerful counterforces that demand constant vigilance.
So what does this all mean for us, for you, the listener? Are we looking at a bumpy ride ahead, or is there a somewhat clear path for investors and consumers, considering all these global and local forces swirling around?
Well, what's fascinating here is we're currently witnessing this global financial dance, intricately choreographed by the twin forces of inflation and central bank policies, all while trying to navigate these complex geopolitical steps.
A dance, I like that.
The market is largely pricing in a relatively soft landing for the U.S. economy. The idea that inflation can come down without a deep recession and a gradual controlled normalization for Japan. That's the base case music playing right now. But as we discussed at length, there are powerful counterforces at play, from geopolitical tensions and tariff-driven inflation to the subtle yet impactful influence of political interference in central bank autonomy. Any of these could easily change the rhythm of this dance, making the path ahead less of a clear highway, more of a winding, often foggy road. A road that demands constant attention to the underlying signals, not just the fleeting headlines. Agility, critical thinking, and a deep understanding of the interconnectedness of all these events, monetary policy, tech, geopolitics, domestic factors, will be absolutely key for you to navigate effectively in the coming months. Thank you for joining us on this deep dive. This was ZZ Financial. We are committed to providing the most accurate, valuable, and timely information and analysis. As central banks try to navigate these choppy, unpredictable waters, consider this provocative thought. What role will consumer behavior, that collective force of billions of individual decisions, ultimately play? Will households, grappling with rising prices, eroding savings, maybe shifting priorities, will they ultimately drive the next big market shift through their spending and saving habits? Or will the power remain firmly in the hands of policymakers and corporate giants, dictating the economic future from the top down? It's a question worth pondering as we move forward.